This was a CPI print that only 8 among the 65 forecasters in Bloomberg survey predicted. This is a slight lower number, but it's caught a lot of folks by surprise. Does this mean the Fed is done? Is it mission accomplished?
Well, I think the probability is that the Fed is done. I felt that way for some time. And I also feel that what we really should focus on is not how high, because we're either done or maybe there's another 25. I doubt it seriously, but how long? And that's ultimately what will determine the direction of the real economy.
Yeah. Well, Ralph, to that exact point, it's one thing for the tightening cycle to be over. It's another for a new easing cycle to begin. Do you think the market is getting ahead of itself in terms of expecting the Fed to be possibly cutting big by mid next year?
I personally do. There's still a lot of positive momentum in the economy. And I do think there's a disconnect between what the markets are saying about Fed expectations and the performance of the stock market. If you believe those Fed expectations, a 50 basis point cut by July, that's telling you that the market, at least the Fed funds market, forward Fed funds market, believes that we're going to have a weak economy and that the Fed is going to have to cut. That's inconsistent with the earnings expectations that are baked into a strong stock market.
Ralph, let's talk about the bond picture of that piece, because the rally is immense, as we're just talking with Mike McKee about it. Front end lower by 18 basis points, 30-year some 15 basis points. We just had a Bank of America survey that showed investors the most long bonds since 2009. We're at levels that we weren't even at during the 2010s bull market rally in the bond market. Is this the sea change? Are we here where bonds are finally back, or is it a false dawn?
I think bonds are very attractive right now, partly because I am concerned that the stock market and earnings expectations are a little ahead of reality, because I do think we're going to have a weakening economy next year. And that would be a very good environment for bonds, because it means inflation will continue to come down, and it means that real returns, the yield minus the inflation rate, will be very attractive.